Righto, Matty Fernley, mate. I reckon JD's got a bit of a man crush on you. He's just been reading your battery materials review. You're the main man of it. Mate, he's very... Now, this guy reads a lot. Awfully complimentary.
Well, thank you. That's all I can say.
Have you been given as good of a plug as that in history?
That is a great plug. I can't say any better than that.
Yeah, so give us a bit of just a quick history on it. How long you been doing it, and what's it about? It's bloody high level stuff.
Yeah, so BMR, I've been doing it for about 5 years. Before that, sort of 20 years as a mining equity analyst on both the sell side, sort of broker side, the dark side, if you will. Started the battery materials review yearbook couple of years ago as a way to really sort of put information into the industry, because one of the things that we're really struggling here with is that generalist investors can't really get their head around the industry. It's a very complex industry. It's not your typical mining industry. There's lots of moving parts, excuse the horrific pun. And, you know, I wanted to put information into the industry really to stimulate conversation. And that's what the yearbook is about. It's a free resource. It's downloadable from our website, batterymaterialsreview.com. You just need to sort of put your email address in and bang, it zings across to you. And not just me, I invited a number of sort of guest consultants, independent consultants, to put their tuppence worth in about their sectors this year. And there are some really fascinating articles. Yeah.
Matt, let's get straight into it then. You just came out with the 2024 edition, and right up front, I think in the first page, you spoke about how you called lithium wrong throughout 2023, like a lot of the market did. And you make reference to a couple brokers calling it right, although coming on the back of, you know, a number of years of them having called it wrong. And yep. The question that sort of comes to mind is, how do you build confidence and conviction in forecasting anything really in this space, whether that be EV adoption numbers, you know, the price of lithium or all these sorts of things? How do you get confidence in that?
It's difficult. I mean, I've been forecasting commodity prices for nigh on 20 years. In this game, you say, you know, if you're a good analyst, you're right 60% of the time. You just can't be right all the time. If I was right all the time, I'd be sitting on a beach somewhere sipping a margarita, you know. I'd have way more money than I do.
Shitloads if you were.
Yeah, exactly. Exactly. So, you know, we're analysts. We try our best. We do analysis, do our detailed analysis. You know, we try and get it right, but sometimes we get it wrong. And, you know, to be a successful analyst, you have to accept that sometimes you're wrong. Try and look at the mistakes you made, try and correct those and use those the next time. So, for instance, you know, when I was forecasting the Chinese secular demand event in 2002, 2003, I cannot tell you how many mistakes we made. We made mistakes up the wazoo. We were making mistakes left, right, and center. The duration of the event, the magnitude of the event. You know, we made loads of mistakes, but you take those mistakes and then you apply them. And that was how I was able to be right on the shape of the EV demand curve over the last 2 or 3 years, because I'd already seen a secular demand event. I'd seen that the growth rates were faster earlier on, and then they start to slow down over time. And that's why I had the right call and a lot of the sell side didn't. Now, this time I had the wrong call. The reason that the call was wrong was because we didn't have an idea of how much inventory build there had been in the supply chain and how that had brought the demand forward. Since then, obviously, we developed data on the inventory curve. So we've developed data not just on the lithium inventories, which was what we were already tracking, but also on the cathode inventories, on cell inventories, and on EV inventories. But as an analyst, you can never have too much data. So we're always developing more data and more sort of signposts, if you will, to get an idea for the direction of the industry.
Matt, can I just ask, how did everyone get the inventory equation incredibly wrong at the exact same time? Like, how did that happen?
I think a lack of data. People weren't thinking about the industry in that context. So, you know, I'm a raw material analyst. I track raw material inventories. So I was tracking lithium inventories, and lithium inventories really weren't that elevated. They're about a month's worth of supply. And then demand dried up, and we were sitting there going, well, this EV thing's still happening. Why has demand dried up? And then we thought, well, maybe there's inventories up the chain. And one of the things that I tracked for a long time in the lithium industry was that one of the things that I got wrong, for instance, in 2020, I actually called lithium price. I expected lithium prices to increase in the first part of 2020 when European EV sales actually went through the roof in the second half of 2019 rather. Now, obviously, there was that little issue called COVID, which kind of tripped up forecasts. But I did actually expect lithium demand to pick up in probably the middle of 2020 after COVID, because EV sales were going so strongly. But what went wrong is that the supply chain is much, much longer than you would think it is. So, I mean, if you think about it, if I mine my lithium in Western Australia, I transport it by boat to China. It sits in a port for ages at Shanghai or wherever it comes into the country. Then it sits on a stockpile. Then it gets moved to the conversion plant. It gets converted. It sits somewhere for a while. Then it goes off to a cathode plant. It gets changed into cathode. It probably sits somewhere for a while. Then it might go off to somewhere else in China, or it might come out to Korea or Japan to go into a cell. Then that cell gets made. Now that cell might sit at the plant where it's made and go into an EV somewhere close by, or it may go into an EV halfway around the world. So the supply chain is really long, and that's something that, you know, I've struggled with as an analyst. I know a lot of other people have struggled with as an analyst. Just because EV sales is accelerating, it could take 6 months before you see an impact in terms of lithium demand. So you have to be aware of the supply chain at every level before you can make a call. And where we tripped up last year is we weren't tracking all the levels of the supply chain.
Is that 6 months? Is that saying from upstream all the way into an EV, 6 months, or what time frame do you put on it?
Well, I mean, in terms of what happened in 2020, and obviously we had COVID in the middle, which kind of tripped stuff up, but we didn't actually start to see the price impact until June, July of 2020, when EV sales in Europe accelerated in the final quarter of 2019. So, you know, 6 to 9 months is the length of the supply chain. Now, you know, if you're a brine producer in Latin America, for instance, supplying to a captive plant and everything, maybe you're slightly shorter because obviously I don't have to dig it out of the ground, concentrate it, convert it, and then send it on. So maybe that's slightly shorter, but and I mean, at times it can be shorter. I mean, if I'm a lepidolite plant in China and I'm, you know, right on top of a captive cathode plant and an EV factory, then maybe I've got a shorter supply chain than if I'm producing in Western Australia or Africa or something. But that's kind of the rule of thumb that I've been using. And indeed, if you look back at the restocking cycle last year that came in April, May, I think it was, I was expecting that to come straight after Chinese New Year, and it took 2 or 3 months to start to come through. So definitely the supply chain is always surprising us in terms of its length.
Matt, in terms of supply, you know, you said at the beginning there that you're a raw materials analyst first and foremost. And I want to touch on Chinese lepidolite. It's been a huge sort of point of contention here. And, you know, it really comes down to data and not being able to get good data. So I want to hear about your conviction in the space. You mentioned in the yearbook that roughly 60% of Chinese lepidolite is closed at current prices. How much sort of confidence do you assert that with?
Not a lot. I mean, I've been a China specialist for 20 years. And, you know, there's lots of data available for China. How reliable is it? I don't know. And I think in Chinese data, the trick has always been to look at points of inflections rather than absolute data levels. But, you know, I do track a fair amount of Chinese data. What we're seeing in terms of the capacity versus production data does imply that a lot of supply is currently idled. And, you know, the big question on Chinese lepidolite is, what's the marginal cost of production? And I think that there's definitely a disagreement between, some analysts in terms of what the marginal cost of production is. My own feeling is it's around about $25 a kilo, but some analysts are suggesting that it's much lower than that. But I think for the industry, it's $25 a kilo because a lot of supply is currently idled. So maybe for the operating mines, it's lower. But I think the other issue with lepidolite that we have to be aware of is there's a lot of waste material generated, a lot of it's acidic waste, and it's got little nasties in it, like sort of trace elements and whatnot. And, it's a question of how you deal with that waste material in terms of the costs. So, is the cost of operation just the mining and concentrating cost? Or is the cost of operation the mining and the concentrating and the waste management cost? And I think some Chinese analysts are just taking the mining and concentrating cost and are ignoring the management cost, which obviously becomes more and more important as your mine gets older and older. Because you've got two issues. First of all, you've got a huge pile of waste material, and that gets bigger and bigger, and driving to the top of that pile requires more and more fuel and more effort. And the second issue, of course, is purely from a mining engineering point of view, that these bodies are, pegmatite intrusions. And if, I'm mining at the beginning and it's quite a wide intrusion, then fine, I won't have a stripping ratio. But as I get deeper, I'm mining more and more waste material. So my operating cost of mining is rising as well. So I think, when I talk to a lot of the analysts, the consultants in China, they're young kids, often with a chemical engineering degree or something. They're not miners, and they don't understand, possibly some of the questions to be asking. So I'm pretty happy with my $20 to $25 a kilogram estimate for what the marginal cost of production is. I talk to a lot of miners who have been on the ground in China, who know the right question to ask. But I haven't been able to get into China to actually see it for myself just yet.
We'll cut him off briefly there, because talking about these Chinese lepidolite mines and what they look like, I could probably bet me bottom dollar that they don't have a VRIFY model.
It's a good thing they don't have to play in our game down here and constantly tap the equity markets, because if they had VRIFY, they wouldn't be getting an awful lot of capital.
Imagine if we could break VRIFY into China.
I reckon.
Talk about a return on investment.
Yeah, they love the opacity of the market there, mate. Xi Jinping is not watching our ads.
I don't think Mr. Xi Jinping is going to be looking to get any VRIFY models.
We should start a movement to get VRIFY in all these Chinese mines.
I tell you what, China could use it for though, mate, because the Chinese obviously only have access to this shit lepidolite stuff. They've got some brine and shit lepidolite. But if they use VRIFY AI, they might find themselves some spot.
Hey, now we're talking, Trav.
Imagine that.
Mate, Steve, I reckon, do you reckon it goes against their mandate to, I reckon VRIFY would sell to China, wouldn't they?
Mate, they just care.
I actually don't know, mate.
They just care about the mining industry, mate. That's what they're all about.
Mate, if they can make mining better in China, then China won't be China anymore, courtesy of VRIFY. That is a real possibility.
Better pitch for all the non-Chinese miners out there, use VRIFY AI and find some spod in the West. Support the West.
Yeah. So pretty much VRIFY is going to be the key either way to taking China's stranglehold off us.
That's
so
if
we can find another green bushes, mate, if we can find another bloody Jubilee. Imagine if like there was a new Cariharmanis, like a high-grade nickel deposit found in Australia where you could mine it at bloody $7 a pound. Who gives a shit? But you won't find it unless you got a VRIFY AI bloody algorithm trying to find it for you.
Well said, Matty. If you want to save your shareholders' capital, get in touch.
If you want to save the world.
Get in touch with VRIFY, and we'll cut back to our chat with Matt Fernley.
So is that marginal cost of production, that's just to get it to concentrate. What takes into account their vertical integration with their own converters?
That's an integrated cost.
Oh, that's an integrated
cost. So you've got lots. You've got two lots of waste material at the concentrator and at the processor, at the converter. So so if you look at it, your spodumene concentrate is probably between 4% and 6%. Probably call it 5.5% these days. Your lepidolite concentrate is much lower grade. It's about 3% or something, 3.5% in transit, and then it goes to the concentrator, and then the converter, and then there's a lot of waste material, as I said, with acid, with bits and pieces like cesium and rubidium and barium and other bits and pieces in there that are deleterious. So how you deal with your waste is pretty important.
So Matt, lots of people have been talking about incentive prices and where they sort of need to get to, and elaborating on the cost curves in recent times. And you had an interesting few comments in your recent podcast that you did, distinguishing between the incentive price and the break-even price. And what I specifically want to hear your thoughts on, is how the Chinese government influences what this incentive price is for the China-based mining companies and perhaps integrated battery makers.
Well, I guess the incentive price at the end of the day is about the cost of capital. And, the cost of capital in the Western world is different from the cost of capital in China. Maybe there isn't actually a cost of capital in China. And that's, important, because obviously when we calculate the incentive price, we're calculating the IRR. So the internal rate of return, you've got to put a discount rate on it. So it's the cost of capital. So that if the cost of capital is, say, 2%, for instance, then your incentive price is going to be much lower than it would be if your cost of capital is cost of capital is around 10%. For most Australian development projects. I mean, if you've got an emerging market development project, it could be much higher than that. It could be like 14, 16% or something. So, the cost of capital that's available in China and the how should we say, lower focus on project economics makes it easier for the Chinese to run at low incentive prices. And I mean, we see that to some extent with the Indonesian nickel sector as well. And I think what the Chinese are so good at, and certainly we've seen that in the Indonesian nickel sector, is coming up with sort of like a modular design, which they can then churn out en masse. I mean, if you look at the HPAL in the nickel sector, in the nickel laterite, it was a big issue to develop the first few HPAL plants, and they were a complete disaster. I mean, let's be fair about this. But what the Chinese have done is they've arrived at a design which seems to be modular, that they can basically just drop in and then adjust for each iteration. And the Chinese are very clever at sort of building to scale very rapidly. And I think that's what we've seen, in lithium.
I'm waiting for the CFAs to comment immediately saying there's no discount rate in IRR calc, but I assume you meant NPV. But why would it be that the cost of capital can effectively be zero for these Chinese miners? Like what's the implication there? Is the insinuation that the state ultimately prints money for free and that can be used towards the capital for these projects?
I mean, I think it has been. I mean, ultimately, if you got into trouble in debt in China in the past, then chances are, if you were a sort of core project, you got bailed out. So it didn't really matter. I mean, you were borrowing money, but if you were a core project, someone came in and sort of, helped with that. So what it's something that as global analysts, we've struggled with for a long, long time. And, it's definitely, I think there is now a cost of capital in China, but it's significantly lower than it is in the rest of the world.
Matt, can you expand on conversion costs? We spoke about it a bit earlier. I want to go into that a little bit and just learn about it myself. So From the yearbook, you quoted that these dropped from roughly $40 US a kilo down to 10 as the lithium price came off over 2023. And
so that's a non-integrated conversion cost, yeah.
Yes, yeah, that's right. And I'm keen to learn how you see this changing in future as more plants are built and perhaps as more offtake contracts and more integration occurs.
Yeah, I mean, I think it's a very difficult one. I mean, up till now, you've had one sort of hydroxide converter generally for one ore body, or maybe one hydroxide converter for maybe sort of 2 or 3 ore bodies, and the material has to be really carefully qualified to go through that converter. And obviously, a lot of people coming into the industry from outside, Tesla included, have suggested, well, why can't we just build a converter and stick any old stuff through it? So far that hasn't worked. So that hasn't worked because of the specification requirements in the industry. But anyway, so that's by the by in your question. But basically, the non-integrated conversion costs. So basically, what I'm talking about here is a non-captive mine supplying to a converter that just buys material in the market effectively. So that's related to what the spodumene concentrate price is. So obviously, if the spodumene concentrate price is, say, $5,000 a ton, you can assume that the non-integrated conversion cost is going to be probably around, maybe $40 to $50 a kilogram, so $40,000 a ton. And then obviously, as the spodcon price fell, then the non-integrated conversion price came down quite rapidly. And that then impacts your cost curve, because it's reducing the highest cost producer on your cost curve quite rapidly. And that's why the marginal cost of production came down so fast. And I think this is another mistake that I and a lot of analysts made, that we didn't realize how dynamic the cost curve could be as we move from annual to quarterly and now to monthly pricing. So the cost curve is much, much more dynamic, really, than practically any other commodity I've ever studied, really. And the cost curve for lithium will now move in line with effectively what the spodcon price does. So at $1,000 a ton spodcon, we're probably looking at non-integrated conversion cost for hydroxide of maybe $10 a kilogram, $10,000 a ton. So the high cost producer became the middle of the cost curve very, very rapidly.
Fascinating. I'm keen to expand on China. So we've spoken about it in just about every question so far, Matt, mm-hmm. and it's a topic that constantly comes up. We spoke about it in an interview we did yesterday, this idea that the EV makers out of China are just growing and growing and growing, and we're seeing it in BYD, in Geely, in all these various automakers' numbers, that they're just winning market share, whether that be through EVs or plug-in hybrids. And I'm interested to hear how you, with your insight into China, think about their sort of growth, in particular their growth in places like Europe, and what perhaps the EU and such will do to stop this.
Mm. Yeah, I mean, I think when you look at China, I mean, we've known obviously for a long time that China is a manufacturing powerhouse. We've known that when they find a technological system that works, they can do it at scale and do it very rapidly. And the writing was on the wall when the Chinese government 7 or 8 years ago identified EVs as a core industry for development. And initially that was going to be for their own domestic use, but then there is also the potential to launch Chinese EV manufacturers as national champions into the world. And I think, let's be clear about this, there is a perception in parts of the Western world that Chinese EVs are substandard units. They're not. They're market leaders in terms of technology and quality and really imagination and solutions on the road. I mean, some of the Chinese LFP battery formulations have completely changed the nature of the industry in terms of the chemistry of cells that are used. So, let's just put this here, that they're not exporting rubbish into the world. They're exporting high quality vehicles at much lower costs than European and US producers can do. I mean, just to give you an idea of what this means. So in Europe, the median price of passenger vehicles, so cars on the market, is around about 15 to 20,000 pounds a unit. The median price of what the EV offering is currently is £35,000 per unit. So we're just not selling EVs that can compete in the mass market. The lowest cost EVs in Europe retail at around £20,000 to £25,000. So if you look at, for instance, the new Renault 5, which is just launching in Europe with lots of excitement and fury and everything, that's going to retail at, I think, €25,000. That's the lowest ball. That's still miles above the mass market for EVs. If you look at the BYD Seagull, which is a comparable vehicle in most areas to the new Renault 5, BYD have recently lowered the price of that to $9,500.
Jesus.
So just think about that, $9,500, under $10,000 for a vehicle in the Chinese market. Now, nobody in the US and in Europe can compete with those sort of costs. And those are profitable costs for BYD. So, there's two things at work here. First of all, are we worried about, Chinese exports coming in and drowning out domestic car makers? Well, obviously that has to be a concern. But the key point about this is that the Chinese products, certainly in the lower value area, are filling in a niche that the Western world car producers can't fill. And if EVs are going to be successful, then we need to have cheap EVs. EVs can't be 25 or 30,000 pounds at the bottom of the line. They've got to be 10 or 15,000 pounds new, because if they can't be, then we'll never get to mass market on EVs.
Because there's no cheap second-hand ones you can buy now, is it? Because they're new.
Well, no. I mean, to be fair, I mean, a lot of EV costs have come off. I mean, obviously, there's been price discounting over the last year, and there has been a big reduction in EV costs in the second-hand market, and indeed, in the primary market as well. But we're still nowhere near, mass market. So we need cheap EVs, but similarly, we have to worry about protecting indigenous industries as well. And I'll maybe just give you an idea for what's going on in terms of trade protectionism. There's a very famous company in America, which is a manufacturer of low-cost vehicles. In fact, manufactures the most popular vehicle in the US. Its name is Toyota, that famous American company. So this isn't the first time that we've seen this. Manufacturing improvements from overseas pushing vehicles into home markets, and I think it's just down to how the EU, how the US governments look at bedding these vehicles down, because I can't see a situation where the European and US OEMs will be able to produce cars as cheaply as they do in China anytime soon. And if they can't, then we need these low-cost Chinese EVs for the energy transition to succeed.
So that makes me think about, government policies, tariffs, various interventions. You got tax incentives to buy the things. And that's been pretty commonplace in every continent. You've got tariffs on Chinese cars coming into America. You've got government supporting Chinese automakers within China. And same goes in Europe as well. Picking into the various sort of packages and subsidies and stuff we've seen, the IRA is the big government policy that has probably drawn in the most attention over the past year. How do you see that influencing the supply chain?
Yeah, I mean, the IRA is an amazing piece of legislation. I mean, it single-handedly sort of supported the energy transition last year, in what was a really tough year for the energy transition in the EV space as well. So I worry that the EV is not going to be affordable in its current format for the US. I think it's very clear. I think now estimates suggest that the IRA is going to cost 3 or 4 times what it was envisaged to cost. So I worry that it's not going to be affordable. Obviously, it's election year in the US. The IRA is very much a sort of focus for both candidates, or both parties, we should say. Is it going to be open season on the IRA? Both the Democrats and the Republicans going to roll back aspects of the IRA? It's possible. How viable is it for US taxpayers effectively to support supply chain developments in countries like Morocco and Indonesia and other countries? So yeah, I think that the IRA will get dialed back. I was at a conference in Europe back end of last year with a whole bunch of Chinese companies, and they only had one question: how do we get into the IRA? And I was like, well, you can't. That's the whole idea. But they weren't taking no for an answer. And I mean, we're seeing investments in cathode capacity going into Morocco, which is a free trade country. We're seeing Chinese companies looking at Mexico. We've seen the CATL Ford deal. So the Chinese are still sort of pushing around the margins to sort of get into that. And I mean, it's a really interesting situation. I don't think the EU is as negative on the Chinese as the US is, but the US is very, very negative on the Chinese. And there's a strong potential for even further pushback on the Chinese getting in. But having said that, as I said earlier, the Chinese are very, very important to the EV supply chain at the moment.
You won't get an EV for 10 grand in the US, made in the US, ever.
No, not now that the workers' salaries have gone up as well. So yeah.
So how do you think, Matt, about these the various forecasts in EV adoption? You've got pretty contrasting rates of growth by the sell side and obviously various buy side commentators around the industry, and you've been quite bullish in the past and perhaps said that the sell side is a bit soft in their forecasts over 2024 and 2025. And I mean, just going off last year's numbers, I think it was 35% off the top of my head, looking at the global whole market, both plug-in hybrids and EVs. How do you think about that?
Yeah, so I mean, I'm actually just published today Battery Materials Review, which looks at our EV forecasts for 2024. And again, I think that the sell side is a little bit conservative. I think there's one area in particular, and I did flag it in the yearbook as well, where I think the sell side is getting it wrong at the moment. The sell side tends to focus on developed markets, so they focus on the Europe, they focus on the US, and they focus on China. But there's one very important region, which let's call the rest of the world, which is growing enormously rapidly. So in 2020, we sold 200,000 EVs in the rest of the world. In 2023, we sold just under 1.3 million. So that area is growing very rapidly. And within that, there's quite a spread of countries, but there's countries like Canada and Australia, where there's a lot of disposable income. And then there's emerging market countries, which are very populous, like Turkey and India, and some of the Asian countries, which are growing pretty rapidly, and where there's, substantial potential to add a lot of vehicles. And I think a lot of sell-side analysts and other consultants are forecasting bottom up, and they're not looking outside the box, as it were. So, I go in and forecast in 4 areas: rest of the world, China, US, and Europe. And really, to some extent, it's my rest of the world forecasts that are pulling my EV sales forecasts up for 2024. On the penetration, I think it's a really interesting question. There's no doubt that EV take-up in some countries has slowed, certainly in Europe and the US. There have been a couple of issues at play here. First of all, the high interest rates, which I think have deterred consumers, made it even more unaffordable to buy EVs. And then the second issue is there's been a number of well-publicized issues with fleet demand, fleet companies dumping named manufacturers. But I don't think, and I should emphasize here that fleet demand has been a major driver of EV sales in developed markets over the last 2 or 3 years or so. So, there is a feeling among analysts that fleet demand is dead. I don't think it is. And that also makes my developed market forecasts a little bit higher than maybe consensus is as well.
Matt, when we think about what lithium demand going forward will look like, I mean, there's a few factors. There's obviously you map out your EV adoption, but another huge driver there is what's your lithium intensity in those EVs going to look like over time. And I'm keen to unpack how your evolution sort of thinking about this has changed over time, especially with some of the surprises looking at the plug-in hybrid adoption.
Yeah. Well, I mean, first of all, let's talk about the type of lithium, because 2018, 2019, it was all about hydroxide. LFP as a chemistry was dead and buried. Now it's the fastest growing chemistry in the world, and it's back to carbonate. So first of all, there's the type of lithium. The second point, of course, is plug-in hybrids, and it was very interesting that in 2018, 2019, when Europe was first sort of accelerating as an EV center, it was the plug-in hybrids that did really well, because they sort of cured your range anxiety issue. But the EU really clamped down on that because they didn't see plug-in hybrids as a technology they wanted to support. They wanted to push BEVs and basically eliminate gasoline altogether. So plug-in hybrids kind of fell in growth in Europe, and we thought for a long time that they were kind of over. They were being phased out, and then over the last 18 months, they really started to take off in China in a big way. 40% of sales at one point were plug-in hybrids, and we're seeing quite substantial growth coming through over the years. Now, I guess the success of plug-in hybrids, or where you see plug-in hybrids going forward, comes back to some extent to see where you see oil prices going forward. And I'm very lucky with the sort of hedge fund that I advise, that I work with some really forward-thinking guys in the oil space who do a lot of demand work, supply work on the oil space. And they have a view, which I've adopted.
Shout out Westbeck.
At Westbeck, yeah. They have a view that I've adopted, that oil prices are going to rise structurally over the next 5 to 10 years. And if that's the case, then I can't see plug-in hybrids maintaining this sort of market share for long, because why wouldn't you go back to BEVs and have no exposure to oil prices? So I do think plug-in hybrids are going to be important over the next 2 or 3 years, maybe 4 or 5 years. But I think beyond that, they'll start to lose market share. But then, as you said, that's very, very important, because your average plug-in hybrid has a much smaller battery than a BEV. So the average battery size in the world at the moment is about 60 kilowatt hours. The battery size in the US and Europe is much larger than that. It's probably about 70. In the US, it's maybe closer to 80. And then the average battery size for a plug-in hybrid is much smaller. But the Chinese plug-in hybrids are a little bit different. So in China, the average battery size for your BEV is much smaller. It's about 50 kilowatt hours. And that's because there's a lot more of these sort of low-cost EVs in China, so small EVs. But the plug-in hybrid battery size is about 25 kilowatt hours, so about half of that. Whereas the plug-in hybrid battery size in the rest of the world is about 13 or 14 kilowatt hours. So it's much, much smaller. So really, does the Chinese model for plug-in hybrids take off? And I think it probably does, because it gives you a longer battery-driven driving distance. And if I'm commuting, 5 or 10 miles into work every day, then I could run that entirely on batteries, if I had a longer driving distance. So my gut feeling is the battery size in plug-in hybrids will start to increase on average. But I do think that we're getting to a point where the battery size in BEVs will start to stall, because I think we've got to that point where we've got the balance. And I mean, I know that 5 years ago it was all about range when it came to EVs, but now it's much more price elastic, and I don't think people want to pay through the nose for for high ranges.
But if the fuel prices go up, but with the non-China ones the way they are now, is it still significantly cheaper to run the plug-in hybrids than a gasoline, even if the fuel price has doubled?
So, I mean, there's lots of moving parts with that. I mean, it depends obviously on electricity costs as well. But it'll be, I think if fuel prices do go up, it becomes, well, assuming battery prices stay at, reasonable levels, it becomes more effective to run BEVs and plug-in hybrids.
Matt, you touched on earlier on the Chinese sort of proportion growing to almost 40% in plug-in. Can you expand on why that growth occurred so largely there?
No, not really. we don't really know. I mean, BYD launched a number of plug-in models which were very, very successful last year. So they've been very successful over the last sort of 12 months or so. But we don't really know, why the consumer adoption for plugins sort of went the way it did, but clearly, some models were launched, they went down very well. More models were launched, they also went down very well. And they're just nicely balanced vehicles. You don't have to worry about range to the same extent. And many people who know about EVs always saw plug-in hybrids as the sort of bridging technology between ICEs and BEVs. But because of what happened in the EU, the technology sort of went away for a while. But, it ticks lots of boxes. It uses less fuel for close-in commutes, and which is, 80% of most people's driving. And it still provides, the range that people need on a one-off basis occasionally. So you speak to people who are involved in the technology of EVs, and I'm sure they'd be very happy about the renaissance of plug-in hybrids, because it is a nice, sandwich technology, if you will.
And so one of the other debates has been between LFP and NMC batteries, and sort of leading that onto nickel. It's been pretty disastrous what we've seen in the West Australian nickel industry over the past year or so. And one of the topics that keeps coming up is this green premium. And I'm keen to hear, I know you've spoken about it in the past, but do you anticipate in any of your forecasting that, perhaps there is an intervention and that actually having a meaningful impact on the nickel space?
Realistically, there can only be an intervention if it comes from a government, because the industry is not interested in green premiums. The auto industry is interested in getting the lowest cost commodities available, and that's become very, very clear over the last 2 or 3 years when, despite the ESG risks of investing in Indonesia, we've seen OEM after OEM, a lot of major, even European companies investing in, Indonesian nickel projects. So, I mean, we've talked about the green premium for a long, long time. It hasn't happened. It's not really happening in nickel, in aluminium. The only industry where we actually see it happening at the moment is in polysilicon, where the European polysilicon price is about twice what the Chinese polysilicon price is. So few manufacturers of European polysilicon. In the nickel market, I think it can only work if governments sort of impose it. And I can't see it happening at the moment. Maybe it happens sometime soon. I mean, I personally don't think it's a great solution for the OEMs if we just rely on Indonesian nickel, because we have exactly then the same situation that we had in the DRC with cobalt, that if there is a disruption to supply in a specific region, then you're going to lose 60 or 70% of the industry's supply. So it behooves the OEMs to think a little bit more globally, but certainly the evidence for the last 4 or 5 years is that the OEMs don't necessarily think strategically or globally about the industry. And what's become very clear from the lithium example is that they didn't really go in and do very much upstream analysis. They just assumed the cells would be there, and it's a normal commodity industry, like how they interact with the steel industry and the aluminium industry currently. So the OEMs haven't really done a lot of strategic analysis on the upstream part of the industry.
Now, Matty sounds like he talks to a lot of people, and a lot of this is on the back of mineral discoveries around the world, and that's his bloody pedigree. Do you reckon he knows Seamus Murphy? He's been around the traps. I reckon he does.
It's kind of like the upstream and the downstream, though, mate, because Matty is obviously all about the actual what's going on with the commodity, but Seamus is finding it. It's does the upstream talk to the downstream?
Well, but Matt, imagine if we took that commodity away from you, you would have nothing to analyse, nothing to talk about. You take Seamus Murphy and Anytime Exploration out of the industry, no commodities. Commodities. You can't have a commodity if you can't find it. We've already talked about how VRIFY can find it for you. Seamus Murphy and Anytime Exploration execute that find into progressing it towards something tangible that you can hold in your hand that is used in a battery EV. Mate, Seamus Murphy, on behalf of me, thank you for your service to the industry.
Matty, I'm an exploration company out there. What can I use Seamus for and his great team?
Everything. Everything, anywhere, anytime, anything exploration, between the people to drill the holes, the equipment to facilitate getting around the bloody absolute asshole of anywhere, bloody bush scrub.
Store your core, cut your core,
mate,
all of that.
You carry the core in the Polaris that he bloody, mate, they cut it for you. They do the soil sampling. You got to do all that bloody soil sampling, chuck that in the back of his Polaris too.
They'll do your chalk report for you.
Well, I'm thinking,
what are you going to do with
what are you going to do with all that data? I don't know if Seamus and that. I think exploration targets are a bit below their geological capability because they just do mineral resources. Yeah, they don't just come up with
just put results on the scoreboard.
Numbers to dress things up.
Yeah, they will move the earth for you though. I know that.
Yeah. So look, they'll probably do an exploration target if you ask them to, but they just prefer to do a bloody above the board mineral resource estimate. So, mate, anything, anywhere, exploration, anytime, bloody absolute legends. Thank you, Anytime Exploration, for the support, and bloody use them.
Give Seamus Murphy a call.
Right, let's get back to Matty. Sorry to cut you off again, Matty. Interesting on the OEMs. We had a yarn with a couple of Australian fundies yesterday, and one of their comments was that apparently OEMs are approaching some of the mining companies to lock in floor prices that are about 50% above what the current lithium spot price is to secure supply. These are Western OEMs secure supply away from China. You heard anything on the ground of that happening? Do you think it's a possibility?
I haven't heard of that in lithium. I've heard of that in some other materials. So, for instance, high purity manganese, where there is a very limited number of projects around the world. I've heard of Western OEMs being prepared to pay, materially above what the Chinese price is. But I haven't really heard of it in lithium to that extent.
So on manganese there, Matt, I'm interested here because there's so few projects like you say, and the EU Critical Raw Materials Act, I see as a bit of an influence on the very few domiciled European projects that are out there, and you've got all this real opacity coming out of the Chinese market. So how do you think about that particular act influencing manganese and perhaps other sort of niche metals that the EU and their auto industry want to prioritise?
I thought you were going to ask me just about what I thought about the act, which is that it's not worth the toilet paper it's written on. But
two for the price of one.
Yes, how can it impact the manganese? I mean, I hope it can impact the manganese industry in Europe and in Africa. I hope that these projects can be taken on as strategic projects. I think the problem with the EU and the Critical Raw Materials Act to some extent is that the EU runs by consensus, so it requires a lot of sign-offs to get approved as a strategic project. A lot of sign-offs, and is that going to work? So that's going to be a sort of a key issue going forward. Fingers crossed, but not convinced on the Critical Raw Materials Act until we actually see the proof in the pudding.
I'm keen to get your. I mean, talk about manganese. I'm keen to get your insight on the graphite market, which is further in the niche specialty kind of battery metals area. This is an insanely nuanced market, and not only because of how opaque it is in China, but because you've got the substitutability with the synthetic stuff as well, which has really just kind of confounded a lot of people's expectations. And given how tricky it actually is to have decent insight into the Chinese market, what are your big takeaways, and what sort of takeaways do you have of this market that would be useful to investors who are trying to evaluate the potential of graphite investment opportunities?
Yeah, I mean, to tell you the truth, I mean, the graphite industry is the one I think that is the most misread by the downstream and by governments. For me, it's the most dangerous market because China does have this strong whip hand in the processing part of the industry. We had our first warning in back end of last year when Chinese announced these export licenses going in for graphite products. And if that's not a wake-up call to Western governments and Western cell makers about the graphite industry, I don't know what is, because there's no shortage of graphite in the Western world. There is no shortage at all. What there is a shortage of these midstream projects that will take graphite concentrate and upscale it to spherical graphite. We don't make a lot of synthetic graphite in the Western world because it's very power intensive. It's carbon intensive as well. So we just don't do a lot of it. And if we want to have a viable ex-China cell manufacturing industry, then we've got to have these midstream spherical graphite processing projects. And they're just not getting funded. So the issue that we have is, compared even to sort of 2 years ago, the market values of the midstream graphite companies is tiddly. And the cost, the capital intensity of developing these projects is quite significant, and the technical risk of developing these projects is quite significant. And we need to see financing being made available by governments, by cell makers, that's not necessarily equity market financing, because at the moment these things are trading at below investment grade market valuations. So we need to see alternative funding. And, once we see alternative funding in place, I'm sure we'll see a reaction in the equity market. I mean, for me, I've been flagging graphite for a long time as one of the sort of core components of the cell industry, which looks really good value. And I haven't changed my view, even as graphite valuations have gone down and down. But if you are serious about building a Western world supply chain, you need graphite. And graphite is like lithium. Every cell you make, you have to have graphite in it, in your lithium ion cells. So I really think after the announcement of the Chinese sort of licenses, graphite equities spiked about 50%, and then they bled it all off. So you're sort of sitting there scratching your head going, well, do people get it? And clearly people did get it, but then something else more important came up and they decided to go and put their PA into NVIDIA or something like that. But I think for me, graphite is one of those segments which, yes, it is very complex. Yes, there's a lot of technical risk in it, and maybe that puts investors off. But if you're willing to play exploration stocks, surely you're willing to play graphite.
I don't know. I think I might steer clear. I'm too scared of
I was going to say, I don't think you've done an awful lot to alleviate my concerns there. One more sort of niche metal that is, it's one we've spoken less and less about. The price has fallen off, cobalt, and there's this constant discussion that battery makers and pretty much everyone across the chain is looking to remove cobalt from any future batteries going forward. And then you've got the added complexity that it's just a byproduct of nickel mines, and copper as well. So can you get any comfort, and have you got any particular insight in how these battery manufacturers are going about removing the necessity of cobalt in batteries?
Well, obviously we've got the LFP chemistry, which eliminates cobalt altogether. In the sort of ternary chemistry, you do need a little bit of cobalt because it sort of stabilizes the battery, from a stability point of view. So you do need a little bit of cobalt. But obviously we've gone from a situation maybe 4 or 5 years ago when we were looking at sort of NCM 111 with 33% cobalt to a situation now where your most rapidly growing ternary chemistry is NCM 811 with 10% cobalt and often much lower cobalt, maybe sort of 4 or 5% cobalt in the battery. So, we're still seeing growth in cobalt demand for the battery industry, but nothing like what we expected it to be 4 or 5 years ago. And I think if you want to have a ternary battery, 90% of them are still going to be cobalt containing. I mean, we do hear about this sort of LMX technology and nickel manganese technology that's coming out of Europe at the moment, some in Korea, which will have almost no cobalt loading at all. But realistically, there's still going to be cobalt in the battery. But the problem is, because of the panic about supply in sort of 2017, 2018, we've seen a lot of investment in new supply in places like the DRC. You obviously see the cobalt byproduct in Indonesia. And we are sitting in an oversupplied cobalt market. And to some extent, I think we now go back to the traditional drivers of cobalt demand to see what prices are going to do. So we're looking at sort of the industrial drivers of cobalt demand to start to clear out these cobalt inventories in the system. And, if we get the Western world recovery in the second half of this year, like many commentators are suggesting, hoping for, there's nothing to say that, the cobalt market can't tighten up and cobalt prices can't rise from here. But I don't think that the battery industry is going to be the sort of driver that we maybe envisaged 5 years ago. It will be a driver of cobalt demand, but it's not going to be the be all and end all of the cobalt industry, and other demand centers are going to remain sort of key drivers as well. So, we're still seeing quite rapid cobalt demand growth from the battery industry. That's more a volume issue than anything else because of the huge increase in volumes of EVs. So it's not the end of the world for cobalt, but it's not going to be the sort of secular structural demand story that we would have expected 5 or 6 years ago. What
are the other drivers for cobalt?
So it's used as a strengthening agent. So in steels and sort of applications like that, super alloys. It's used a bit in the wind industry, in magnets and things like that. So those are the primary sort of drivers for cobalt, sort of like bog standard industrial sort of technology drivers, rather than sort of the high tech battery industry driver, I think.
Mate, I was we do this regular segment called Overrated, Underrated, and the goal is to just have you sort of respond to a statement or a proposition and just give a one word overrated or underrated based on your your first take. And if you want to substantiate that with a quick statement, then we'll allow it. But the goal is to be brief. Are you up for it, Matt?
Yeah, go on.
I thought you were asking me.
All right, overrated, underrated. Lithium supply to come out of Africa over the next 18 months.
Underrated.
Japanese/Korean capability building out there, lithium downstream processing.
Japanese overrated, Korean underrated.
One I think you've sort of answered in there, but to make it more explicit, your thoughts on whether the EU Critical Raw Materials Act is overrated or underrated?
Overrated.
Thought that might be the case.
Did you get that?
Yeah. The West's pursuit of supply chain independence from China.
Overrated at the moment.
How about whether you think the sort of impending growth or dominance of Chinese OEMs, is that overrated or underrated?
It's a difficult one. I think it's overrated.
The typical analyst assumptions of the lepidolite cost curve out of China.
They're definitely overrated.
My ones are always bloody easy. I'm not as smart as these two. The potential for sodium ion cells.
That's a good one.
I think that's overrated.
This is non-lithium.
To clarify that?
Yeah, go for it.
I think it's overrated at the current time because with lithium ion cells this cheap, why do you need sodium ion?
Last one from me, and this is not lithium related, but seeing as we talked about a bunch of other niche battery metals, and this one wasn't in your annual review, high purity alumina. Overrated or underrated?
Underrated.
Oh, babe, what a place to finish it. Everyone will be reading on high purity alumina after that. You've sent us on a rabbit hole.
Very interesting market, and as you say, not very well known, but a fascinating market.
Beautiful, Matt. Really appreciate you making the time.
Sensational, mate. Thank you.
Thanks.
I usually get JD to just explain everything he's read to me, but I'm going to bloody make an effort and read the whole review myself, Cobber.
Yeah, you can't. There's not just a summary that you can read the front page, unfortunately.
Is it on Audible or Blinkist or something?
Chuck it in Speechify, mate.
You could get one of these guys to read it to you.
Yeah, that'd be good. Yeah, I'll have to get him to do it nice and slow. Very good, mate. Thank you very much. And mate, you're our new battery material go-to man. So
thanks.
Be prepared for a WhatsApp chat group.
Okay, cool.
Thanks again, Matt. Cheers.
Cheers.
Righto, there we go. I'm going to go bloody a bit of nighttime reading for me, JD. Where do you bloody get it again? Is it just you get
battery materials review?
You asking where to get the book, or where did he learn how to read?
Nah, bloody.
I haven't learned that second one yet.
How do you read so good?
Let's not get
Is
into
it on
my
the website? I've got to go bloody get it.
Yeah, you can get it free. So Money Miners, if you're looking for a bit of reading, that one's not bad. Bits on manganese, nickel, everything we sort of spoke about there. He's got a bit of a section on. So
how long is it?
I think it's 60 odd pages.
It's pretty quick. Read the front section. It's all I read in 15 pages.
Yeah, I'll do the abstract.
A lot of neat looking graphs and charts in there for you to peruse over.
Oh, that was. Do you know it's something I learnt that I did not know?
Tell me.
This is so embarrassing when I say these things. I did not know that hydroxide was for the NMC batteries and carbonate is for the LFPs.
You can convert one to the other, but it's added cost.
I did not know that. We're learning all the time. Did you know that?
I had heard that one, yeah. We're learning all the time, mate.
No.
Yes. Yes. No, that was, mate, tell you what, he's our go-to man for anything inventory related. So, yeah, I'm going to pick his brain.
Absolutely, mate.
Great in a WhatsApp chat group. Very beautiful. Money, what would you call it? What are we going to call the group? We've got a name for every group. I love Money of Wet.
Money of BMR doesn't have the same ring as Money of Wet.
Money of Battery.
The better Matt.
Money or smart, Matt. Right, thanks all the partners. Speaking of bloody smart legends, mate, VRIFY and Anytime Exploration at the top of the show. Get both of them to friggin' find some ore for you. Mate, GetWet Solutions, DSI Underground, SMEC Power and Technology, KCA Site Services, Brooks Airways, and Jesus Christ, you want to find some bloody ore? Who do you get?
K-Drill.
Yeah, love it.
Hoodoo, money miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.